stocks gained 115% during history's two worst wars. While millions died in World War II and Korea, if you had invested in the stock market, you would have doubled your money. But here's what Wall Street doesn't want you to know about war markets. We're now on day 3 of the Iran conflict, and the exact same pattern is playing out right in front of your eyes. Let me show you something that will shock you. Every single major war in the 20th century made investors richer. World War II delivered 10% total returns despite being the deadliest conflict in human history. The Korean War crushed it with 18.7% gains. Even Vietnam, during massive anti-war protests, still delivered 6.4% to patient investors. The Gulf War saw full market recovery in just 6 months. When you combine World War II and Korea, we're talking about 115% total returns during the absolute worst wars humanity has ever seen. Here's why this happens, and it's pure economics. War transforms government spending into the ultimate stimulus machine. In 1940, defense spending was just 1.5% of GDP. By 1943, it exploded to 43%. That's not just spending, that's economic rocket fuel. Defense contractors see their revenues jump 25 to 40% during active conflicts. Right now, Congress just approved $20.4 billion in munitions spending for the Iran war. That's fresh money flowing directly into the economy, creating jobs, manufacturing demand, and supply chain activity. And here's the thing that will blow your mind. The current Iran war is following the exact same pattern as Pearl Harbor and the Gulf War. Right now, the S&P is down just 0.7%. Pearl Harbor dropped markets 2.9%, but they recovered in less than 1 month. The Gulf War saw a 10% decline, then full recovery within 6 months. We are literally on day 3 of a predictable pattern that institutional investors have been exploiting for decades. But wait, there's more. The Federal Reserve becomes the ultimate war financier during conflicts. During World War II, they expanded the money supply by 140% while crushing interest rates from 1.5% down to 0.375%. It's monetary policy on steroids. Here's the kicker about the Iran war. It's costing us only 0.2 to 0.4% of GDP. Compare that to World War II's 43%. Plus, America is now a net oil exporter, which means we actually benefit from oil price spikes instead of getting crushed by them. Now here's where most people get confused, and this is where smart money separates from dumb money. Defense stocks are actually down 5.2% right now, despite the Iran war escalating and Congress approving that $20.4 billion boost. Retail investors are panicking and selling everything. But institutional money? They're quietly rotating into exactly these opportunities. Historical data shows defense contractors gained 20 to 35% during active conflicts. Energy producers are already up 8% from the oil spike, and U.S. companies benefit the most because we're not dependent on Middle East imports anymore. Let me walk you through the predictable 4-phase war market cycle that institutions follow like clockwork. Phase 1 is shock, where we are right now. Markets drop 5 to 10% over the first 30 days as uncertainty peaks. Phase 2 is adaptation, starting around weeks 2 through 8, when defense spending kicks in and markets stabilize. Phase 3 is recovery, months 3 through 6, when war economy benefits become obvious. Phase 4 is expansion, 6 to 12 months, when markets typically end up 10 to 15% higher than where they started. The final target based on historical patterns? 13.5% gains. And here's the contrarian thesis that explains everything. While retail investor sentiment is at negative 78% extreme fear, institutional money is net buying $2.3 billion. This is the classic buy fear, sell euphoria pattern that separates professional investors from amateur panic. The best buying opportunities in war markets happen during initial announcements when everyone is scared. Defense stocks ignoring a $20 billion budget boost? That's not a warning signal. That's an opportunity signal. But here's why 2026 is different from every previous war economy. We have unprecedented structural advantages. America is now a net oil exporter instead of being vulnerable like we were in the 1970s. The technology multiplier means modern defense spending creates broader economic impact than ever before. The Iran war costs only 0.3% of GDP versus World War II's 43% economic disruption. The Fed has advanced tools and flexibility that didn't exist in the 1940s. This is a localized conflict, not global supply chain destruction. So here's the bottom line. While retail investors are selling in panic, the smartest money in the world is quietly positioning for war economy gains. History shows this pattern leads to double-digit returns within 12 months. The defense stock weakness despite massive budget increases? That's exactly why institutional investors are buying. If this analysis helped you see the opportunity hiding behind the fear, subscribe to Premium Logic Lab for more institutional-level insights that most investors never get. And share this with anyone who needs to understand how professional money really moves during market crisis. What's your take on the current war economy setup? Let me know in the comments below.